You've seen the headlines. Chinese whale makes $144 million shorting silver. Massive insider bet against the metals market. Is the silver rally over? And depending on which channel you clicked on, it's either proof that silver is about to collapse or proof that a massive short squeeze is coming next. So let's slow this down, because a single large trader making 9 figures on a short position is not automatically the end of a bull market. It's not automatically manipulation, and it's not automatically a signal that you should panic. Today we're going to break down what actually happened, what the data says, what it doesn't say, and what I'm personally doing about it. No hype, no doom countdown clocks, just numbers, probabilities, and a framework. If you're new here, this is Financial Briefing. We analyze precious metals with context, not emotion. Let's get into it. Before we talk about this Chinese trader and the $144 million gain, I want to quickly revisit our own scorecard. Because if we're going to analyze other people's trades, we need to hold ourselves accountable too. Back in late April, when silver was trading around $27.80, we said the breakout above $28 had about a 60% probability of extending to the $31.32 range within 2 months. That move did happen. Silver pushed through $30 in June, topping around $31.80 before pulling back. That was in line with the base case we outlined. In early July, when silver was testing $32.50 and sentiment was extremely bullish, we said there was roughly a 55% probability of a corrective move back into the high 29s or low 30s before any sustainable move higher. Silver dropped to $30.20 within 3 weeks. Again, not perfect timing, but directionally correct. And in August, when everyone was calling for an immediate run to $40, we said the probability of a straight line move was under 30%, and that consolidation between $30 and $34 was the higher probability path. That's largely what we've seen. So we're not here to predict every tick. We're here to assign probabilities and manage risk. Keep that in mind as we walk through this whale trade. Let's start with the first data point. Data point number 1, the size and structure of the short. Reports indicate that a Chinese-based trading entity accumulated a significant short position in silver futures on the Shanghai Futures Exchange and partially mirrored exposure through COMEX linked contracts. The reported gain of $144 million came during a roughly $3.50 decline in silver from about $33.50 down to near $30. To generate $144 million in profit on a $3.50 move, you're looking at exposure in the range of roughly 40 to 45 million ounces, depending on entry price and leverage. That's not small, but it's also not unprecedented. For context, total open interest on COMEX silver often fluctuates between 130,000 and 180,000 contracts. Each contract represents 5,000 ounces. So at 150,000 contracts, you're looking at 750 million ounces of notional exposure. A 40 million ounce position represents roughly 5.6% of total open interest. What it means is this trader was large enough to matter on the margin. In thinner liquidity windows, especially overnight or during Asia sessions, that size can influence short-term price action. What it doesn't mean is that one trader controls the global silver market. The daily global silver trade volume, including OTC derivatives and ETFs, often exceeds several billion dollars. A $144 million profit sounds dramatic. In percentage terms relative to the entire market, it's meaningful, but not dominant. Now let's move to data point number 2, timing relative to technical structure. The short was reportedly built as silver was testing the $33-$34 resistance band. That zone has historical significance. In 2020, silver peaked near $30 before consolidating. In 2021, we saw the retail-driven spike toward $29 or $30 and then failure. More recently, $34 has acted as a multi-year supply ceiling. So when silver approached $33.50, we were entering a zone where commercial hedgers historically increased shorts and speculative longs are crowded. At the same time, the RSI on the daily chart was above 70. Commitment of traders' data showed managed money net longs at elevated levels, not record highs, but near the upper quartile of the past 3 years. What it means is that from a tactical standpoint, shorting into resistance with stretched momentum was not irrational. It was a calculated bet against overextension. What it doesn't mean is that the macro bull case for silver is dead. Shorting resistance in a range-bound or consolidating market is a different thesis than betting on a multi-year collapse. Data point number 3, macro backdrop during the trade. During the period of the decline, the US dollar index moved from roughly 102 to 104.5. The 10-year Treasury yield ticked up from around 4.10% to 4.35%. Real yields, which silver is particularly sensitive to, also moved modestly higher. Historically, silver struggles when real yields rise and the dollar strengthens. In 2013, when real yields surged, silver collapsed from the mid-20s to below $20. In 2022, during the aggressive Fed hiking cycle, silver fell from around $26 to $17 as real yields spiked. This recent move was much smaller in magnitude, but directionally similar. What it means is that the whale didn't short into a vacuum. The macro tailwinds that had supported silver earlier in the year, declining inflation expectations, softer yields, had temporarily reversed. What it doesn't mean is that we're back in a 2013-style deleveraging event. The scale of yield movement is not comparable. We're talking about 20-25 basis points, not 150. So stepping back, we have a large trader shorting into technical resistance with stretched positioning during a short-term macro headwind shift. That's a coherent trade. It's not automatically sinister. Now let's talk about the bull case. Why could this entire narrative be overblown or even set the stage for higher prices? First, physical demand remains firm. Industrial demand for silver, particularly from solar panel manufacturing, has been structurally rising. Estimates from the Silver Institute suggest annual industrial demand exceeding 600 million ounces, with photovoltaics accounting for a growing share. If global energy transition policies remain intact, that demand floor doesn't disappear because one trader made money on a short. Second, mine supply growth has been constrained. Silver is often a byproduct of lead, zinc, and copper mining. With capital expenditure discipline and environmental permitting delays, supply expansion has not kept pace with demand in recent years. That supply-demand tightness can reassert itself once speculative froth clears. Third, central bank diversification trends. While central banks primarily accumulate gold, not silver, broader de-dollarization narratives tend to support precious metal sentiment as a whole. If geopolitical tensions rise or the dollar weakens materially, silver often outperforms gold on a beta basis. Fourth, if the Federal Reserve signals rate cuts more aggressively than expected, real yields could compress. Silver is highly sensitive to real rates. Even a 50 basis point drop in real yields historically has coincided with multi-dollar rallies in silver. Put those together, and there is a plausible path where the short-term correction becomes a higher low before a breakout above $34. But I'm assigning that stronger bullish breakout scenario, about a 30% probability over the next 3 to 6 months. Not impossible, not dominant, but meaningful. Now the bear case. First, speculative positioning remains elevated even after the pullback. Managed money net longs have come off highs, but they're not washed out. In prior durable bottoms, think March 2020 or September 2022, net longs were dramatically lower, sometimes even net short. Second, silver has repeatedly failed in the $33-$35 zone over the past several years. Multi-year resistance levels often require multiple attempts before breaking. Each failure conditions traders to sell into strength. Third, global growth concerns. If China's industrial sector continues to underperform, and if European manufacturing remains weak, industrial demand expectations could soften. Silver is part precious metal, part industrial metal. That dual identity can be a headwind in slowdowns. Fourth, if the dollar index sustains above 105 and real yields move toward 4.5% or higher, the macro pressure could cap rallies. In that scenario, silver could grind between $28 and $33 for an extended period, frustrating both bulls and bears. I assign the more pronounced bearish scenario, meaning a drop back toward $26, $27, about a 35% probability. Higher than the bull breakout case, but still not the base case. Which brings me to the middle case. The middle case, in my view, is that silver remains range-bound between roughly $29 and $30 for the next few months, with volatility around macro headlines, but no structural breakdown or breakout. In this scenario, the recent short was simply a tactical trade within a range. The whale captured a multi-dollar swing, closed or reduced exposure, and moved on. We would likely see choppy price action, false breakouts on both sides, and a gradual compression of volatility before a larger move later in the year. I assign this middle case about a 45% probability. Not exciting, not headline grabbing, but statistically the most likely. Now let's zoom out and look at historical context. Large traders making outsized gains on silver shorts is not new. In 2011, after silver spiked to nearly $50 during the post-financial crisis commodity boom, several institutional players were positioned short into the parabolic move. When margin requirements were raised and momentum reversed, silver collapsed to below $35 within weeks, and eventually to the low 20s. Those short positions generated enormous profits. The similarity today is that silver again had a sharp run into a widely watched resistance level, accompanied by elevated retail and speculative enthusiasm. The difference is scale and macro environment. In 2011, silver had more than doubled in less than a year. Retail participation was extreme. The gold-silver ratio had compressed dramatically. Inflation expectations were different. And Global monetary policy was still highly accommodative. Today, silver TES move from the low 20s to the low 30s is significant but not parabolic on the same scale. Monetary policy is restrictive, not aggressively easing. Retail participation, while present, is not at 2021 meme stock intensity levels. Another comparison point is 2020. During the COVID liquidity crisis, silver crashed from silver around $18 to under $12 in a matter of weeks as everything was sold for cash. Large funds that were short volatility or positioned defensively profited massively. The similarity now is heightened sensitivity to macro data and rate expectations. The difference is that we're not in a forced liquidation environment. Credit markets are not seizing up, liquidity is not collapsing. So history tells us that large profits on short positions can coincide with major tops, but they can also simply mark tactical corrections within longer-term trends. Now let's check cross-market signals. Gold is currently trading around the mid-2,300s. It has held up better than silver during this pullback, which has caused the gold-silver ratio to tick higher again toward the mid-70s. When the ratio rises, it often signals either risk-off sentiment or underperformance in industrial metals. The dollar index, as I mentioned earlier, has strengthened modestly. It's not breaking out to new multi-year highs, but it's firm. A sustained move above 105, 106 would likely pressure silver. The 10-year yield hovering around 4.3% is not catastrophic for metals, but it's not supportive either. If yields drift back toward 4% or below, that would be constructive. So cross-market signals are mixed. Not screaming collapse, not screaming breakout. Now let's talk positioning. The latest commitment of traders data shows commercial hedgers moderately net short, as they typically are. Managed money is net long, but off extremes. Swap dealers are relatively balanced. In other words, we're not seeing the kind of positioning extremes that usually precede violent squeezes in either direction. Bank positioning on COMEX does not show a dramatic surge in concentrated shorts beyond historical norms. That suggests this whale trade, while large, is not an unprecedented structural bet by the entire banking complex. So positioning context supports the middle case thesis more than a dramatic bull or bear scenario. Now let me walk you through my personal action plan. First, current allocation. In my portfolio, precious metals represent about 18% of total assets. Of that, roughly 11% is in gold exposure and 7% in silver exposure. Silver is inherently more volatile, so I keep it smaller than gold. If silver drops into the $28, $29 zone with washed out sentiment and managed money net longs falling sharply, I will likely increase my silver allocation by 1 to 2 percentage points, bringing it to around 8 to 9%. If silver instead breaks and closes above $34 on strong volume, with confirmation from a weaker dollar and falling real yields, I would also consider adding 1 to 2% to silver, betting on a structural breakout. If silver falls below $27 on a weekly closing basis, especially if accompanied by rising real yields, I would reduce exposure by trimming about 2% of portfolio weight. That would bring silver down to around 5%. My mental stop loss for new tactical additions would be around 8% below entry. My first take profit zone on any breakout trade would be around $30, which aligns with measured move projections from the current range. This is not advice, it's just my framework for managing risk in a volatile asset. And what I'm not doing is equally important. I'm not panic buying because a whale made money on a short. One trader's profit does not invalidate long-term fundamentals. I'm not consuming hours of fear-based content claiming that the silver market is rigged and about to implode. Markets are competitive ecosystems. Large players exist in all of them. And I'm not assuming that this is the start of a financial collapse. If that evidence appears, we'll address it with data, but we're not going to invent it. Now let's build a watch list for this week. First, watch the $29, $80, $30 support zone. If silver holds above $30 on multiple tests and volume contracts on pullbacks, that's constructive. A decisive break below $29.80 with expanding volume would tilt probabilities toward the bearish scenario. Second, monitor the dollar index around 105. If DXY fails to break above 105 and rolls over, that's supportive for metals. A clean breakout above 106 would increase headwinds. Third, watch the 10-year real yield. If it drifts back toward 1.8% or lower, silver likely catches a bid. If it moves toward 2.2% or higher, pressure increases. These are objective triggers, not narratives. So let me summarize. A Chinese trader reportedly made $144 million shorting silver during a $3.50 pullback. The position size was large but not market controlling. The trade aligned with technical resistance and short-term macro headwinds. The bull case for silver, constrained supply, strong industrial demand, potential rate cuts, remains intact with about a 30% probability of a breakout scenario in the near term. The bear case, persistent resistance, elevated positioning, firm dollar, carries about a 35% probability of a deeper pullback. The middle case, range-bound consolidation between $29 and $34, is my base case at roughly 45%. Cross-market and positioning data support patience rather than panic. If you appreciate calm, probability-based analysis rather than clickbait countdowns, consider subscribing. We'll continue tracking the data, updating the probabilities, and adjusting when the evidence changes. This is Financial Briefing. Stay sharp.